The tech-heavy Nasdaq seems to be losing its luster as the hopes for lower interest rates drive investors towards the severely undervalued small and mid-cap investments. Will the trend continue, or will signs of a slowing economy shy investors away from following the herd? That action starts now. Markets played a little switcheroo on investors this month. The S&P 500 only finished slightly higher, up 86 basis points. However, the Dow Jones Industrials took over as the outperformer, posting a 4.27% gain led by real estate, utilities, and financials. On the other hand, technology and communications led the way as the worst performers, pushing the Nasdaq lower by 1.57% for the month. Yields all found a path lower for the month, considering that the inverted yield curve continues to inch closer towards reverting back to normalcy, combined with economic reports that are showing signs of a slowing economy. The Fed revealed that a rate cut is likely to be the central bank's next move rather than tightening. As such, the markets are now forecasting a 100% probability of a Fed rate cut in September. Notable events coming up later this month include trends of inflation with CPI on the 14th, retail sales on the 15th showing strength of consumer spending, the Jackson Hole Economic Symposium the 22nd through the 24th, and, of course, Nvidia's earnings on the 28th. Although July through October are notoriously volatile, investors are very challenged with a couple of pretty big dilemmas. First, can the high-powered mega-cap stocks continue to accelerate earnings to keep the unbelievable momentum intact? Second, will interest rate cuts by the Fed be enough to create a movement to small and mid-cap stocks, or will a slowing economy and rising unemployment create a level of fear to make investors go search for investments that are more suited for recessionary fears? Of course, we also have an election coming up at the end of the year, and who knows what havoc that may have on the markets. If I haven't perked your ears up just yet, well, let me leave you with this thought. Take a look at this chart. Every instance that the 10-year 3-month yield curve spread inverted over the last 30 years, the S&P 500 continued higher before completely retracing the entire post-inversion gains, and in some cases, the index fell much more. To put that a little more bluntly, if the S&P 500 doesn't fall below 4,000 in the quarters ahead, it will be the first time in modern market history based on the current market dynamics. So for the month of August, our models continue to hold a 50% allocation to the money market. Our broad focus remains on domestic equities and commodities. Our focus in domestic equities is on large cap growth and large cap blend, with an emphasis on technology, industrials, financials, consumer cyclicals, and communication services. In commodities, our focus is still on industrial metals and precious metals. As a reminder, my current allocation is not a recommendation. Regardless of what happens next, investors like you need to have a simple and yet solid financial plan that reduces risks, costs, and taxes while securing the necessary income you need to maintain your lifestyle throughout retirement. So if you don't have a plan, or you're not comfortable with the plan you currently have, call me today to get pointed in the right direction. I'm Chad Kuntz, and that puts a wrap on the August 2024 Market Action Report. Thanks for joining me. It's time for me to get back to the markets. And that action starts now.